Hey everybody, how's it going? JT here from the Ethfinance and EVMavericks DAO. On behalf of all those beautiful people out there on Reddit, thanks once again to the Mavericks for hosting this 34th happy hour. Give us a thumbs up, smash a bell on the YouTubes if you haven't. Send us a retweet on the Dirty Bird app if you get a chance. And we are real excited today. We got a couple of members here from Lantern Finance. We got Prince right below me. And I got Jung over here to my right, your left up here on the Zoom call. So we're super happy that you guys could join us today.
Hey, thanks for having us, JT. Pleasure.
Absolutely. Well, this is your first time joining a Doots call, but you're kind of an OG person, Prince in particular, from the Ethfinance and probably the E-Trader communities way back in the day. And Prince and I met in Hawaii at HodlerCon, and then he just reached out recently to kind of pick my brain about the stuff that they're doing with Lantern Finance. So we're going to jump into an interview with them here momentarily. But first, let's get our housekeeping stuff out of the way. The Weekly Doots live stream is all about showcasing the best of the best of the best of the week from the Ethfinance community on Reddit. This is a read-along reaction series, and if you want to follow along, head to dailydoots.com, designed and produced by our very own Hanniabu. And while you're at it, go get today's POAP. Big thanks to Turkey Troll for capturing each day's Doots and curating them for us. And of course, the A word for curating this, the weekly list. As always, if you know someone who wants a piece of this action, send them my way. So we're going to jump right into it and get right into our rich list here. Let's take a look. I'm going to switch camera view here. There we go. Check it out. Coming in at number 10, Hanniabu with 53 Doots, Benito 2030 at 56, Scientist at 58, K-Brot resting easy at 60, Set One Less at 62, 696 at 64, Turkey Troll at 67, Crypt Owl Wow Currency keeps rocketing up this list. He's at 73. Logri the Bard is making some headway up there as well at 77, and Super Fizz is the same from last week, sitting at 118. I want to give a personal shout out to Hal, who successfully did a triple kill. I don't know that we've ever had a triple kill land on the Daily Dudes list before. So Hal, congratulations to you. So let's get right into this with the Morning Trinity. Hey, Chibi. What is this username? Hey, Chibi says Ethereum. And user, you got Trisomy 21 clocking in at $1,649. And then we've got Vinegar Strokes at 627 on the ratio. I need to turn on my cameras. That would actually make the live stream a lot more enjoyable. So these are the faces that you might have missed. I just hit the dang virtual camera just now. So all of you folks that were watching on YouTube's, I apologize for having you stare at the OBS symbol for that long. Anyway, so yeah, there's the beautiful team at Lantern Finance. Before we get to them, we're going to jump to the weekly haiku, courtesy of JS Tears. Ever since the merge, block production converge, distrust too may surge. How does he do it? So thanks again for the haiku of the week by JS Tears. Here's our cue by Space Cider. Your daily beacon chain dose, active validators 780,000 up to 2004. Pending validators joining 44,000. How many leaving? Roughly 0. Entry queue is down 1,300 from yesterday's number. It'll take around 16 and a half days for the entry queue to clear. In around 2 days, the amount of daily validators that can both enter or exit will be increased from 2,475 to 2,700. These figures are based on the entry exit queue at the time of posting and can be tracked at Hanniabu's website, validatorq.com. And our ship post of the week, because we always like to start with the best for first. All right. There once was a burly crustacean. Oh, here we go. This is going to be good. There once was a burly crustacean who would not brook a price aberration. It made the charts boring, so instead of just snoring, I packed up and went on vacation. Oh my gosh, that is beautiful job. Excellent ship post of the week. Great job. Filter feeder, which is already that username is kind of its own ship post too. So thank
I
you
love
so
it.
much in that beautiful job. All right. So now we're going to turn back to our friends here from Lantern Finance. If you want to go, I can just tell you right away, lantern.finance. And they've also got, you could join the wait list today. And we're going to learn a little bit about what they have to offer. And we're super excited, first and foremost, that you guys could drop by today. So, Prince, I'll let you start off. And Jung, where did you guys come up with this plan? How long have you been trying to put this together? And what are the next steps?
Jung, you want to take that one?
Yeah, I mean, I could start off with kind of, how we, ended up kind of, building Lantern and focus on the staking space. So Prince and I both unfortunately were, victims of the, crypto implosion late last year. Prince, I think was impacted by Genesis. In my case, I was impacted by BlockFi, unfortunately.
Same.
Um, you know, before everything kind of imploded, right? Like the ability to earn on your crypto in kind, as well as kind of access liquidity through their loan products. We thought, those are fantastic products. They clearly have product market fit. Everyone loved it. But in hindsight, we see that it wasn't really sustainable because the way they were generating, like these crypto lenders, the way they were generating those yields, was by lending out client crypto to, basically like crypto native hedge funds, market makers, etc., on an under collateralized or even unsecured basis, right? And in an industry as volatile as crypto, it doesn't really make sense. Again, in hindsight. So when everything kind of imploded, Prince and I were kind of looking for a different way, like a safer and more sustainable way to kind of access similar products. And that's when we connected and we were brainstorming. And staking is kind of the answer here, right? There is no counterparty because the only, I guess, yeah, effective counterparty that we're interacting with is the blockchain itself. By staking, we generate returns from Ethereum itself for securing and validating the blockchain, right? So that's kind of how we turned to staking. And when we looked at the staking kind of landscape and options for people like ourselves, there were, I guess, three broad categories, right? On the institutional side, it was pretty much kind of there are a lot of options out there like Blockdaemon, Figment, Kion, etc. But for consumers, there's only three broad buckets. First is solo staking, which most people don't have 32 ETH, right? And not only that, you need to have technical fluency. You have to know Linux. You have to maintain your server. Again, that's a pretty high bar for a lot of people. It's definitely a high bar for me, and I've been around for a little while as well. And I think I speak for Prince as well for that.
Yeah.
Yeah, and then the second bucket would be decentralized protocols like DeFi, such as like Lido, Rocket Pool. For those, again, even for people who have been in crypto for a while, I think self-custody is really a scary, at worst, and inconvenient at best kind of setup, right? So, not only that, there's smart contract risk, and LST tokens could be a taxable event. A variety of reasons why, decentralized options might not be the best kind of choice for most people. And lastly, the last bucket that Prince and I kind of came to was centralized exchanges. So like Coinbase, Kraken, before they were kind of kicked out of the U.S. in February, Binance.US, so on. But with centralized options, staking is not their bread and butter, right? Trading is. And not only that, they've kind of grown. All of these exchanges kind of grew into these super apps where they have like 10 different offerings, right? Buying, selling, learn, earn, Web3 port, NFT marketplace, a bunch of stuff. So the UI, like the user interface as well as experience for accessing staking services, is not that clear cut. If you're kind of stuck, their customer support hasn't scaled, right? I think crypto exchanges are notorious for having not the best customer support. You can't really get on the phone with someone, or even if you do, they kind of delegate you off to email support, which can take 5 days to a week for them to even respond. And the kind of like the rotten cherry on top of all that is they're charging. Well, I guess Coinbase in this case is charging 25% of kind of your staking rewards, which we thought there was a better way, right? Like a more an easier way to access staking for the individual investor, for affordable fees, with robust reporting, robust customer support, and that's kind of us in a nutshell. And Prince, feel free to add if I miss anything.
Yeah, no, I think that's right. We want to be, also regulatorily, like first and foremost, very compliant. So we want to set up a more conservative way of like doing staking, like not necessarily like giving folks, rewards immediately as soon as they click stake. Like there is an activation queue that people have to go through, or if there's a withdrawal, an exit queue, like, we're going to follow the protocol and the, schedules laid out by, Ethereum staking as closely as possible. And we're also focused on Ethereum only. We're not allowing for tokens that, may be considered securities, at least at this point in time. So we're really just focused on making Ethereum staking as seamless as possible. And yeah, that's kind of our mission.
So the overarching view is that you're not trying to be a Swiss Army knife service. You're trying to do one thing very well and abstract away these complexities where, for instance, you mentioned Gemini Earn, which isn't even really staking. It's kind of like they're, fractionalizing your assets and lending them to someone else. Which you guys
with Gemini Earn, I mean, they had one borrower really, like, which was Genesis, and they were just handing out their Gemini Earn crypto assets to one counterparty, and then that counterparty blew up. So
yeah, but where I was going with this is like, you're making it as close to solo staking as with the the entry and the exit. It's not like an Earn program or another program where they offer instant, coming in and coming out, so it's like you're minimalizing, in my view. Of course, other people can chime in on this if they have questions, but you're minimalizing the amount of things that can kind of go wrong because you're kind of going straight down the road of what happens at the protocol level. I don't know if that's exactly the way it's set up. Does that make sense? Does that sound like that? It feels like much closer to what solo staking would be, but you guys on top of that are also handling all the insurance part of this. I don't know that we even really talked about the insurance piece of this, because that kind of caught my attention too. With Gemini Earn or, in a lot of these other places, there wasn't like an insurance component to it that I'm aware of. Can you speak to that?
Yeah, sure. So we have slashing insurance, through third party, the staking service providers that we will use. Later on, we want to, for the volume that, is kind of sticky, I guess, like people who want to stake on our platform and aren't necessarily looking to like move in and out very often. We're going to move that to like BitGo's cold storage custody solution, which is insured up to $200 million.
Oh man.
But
yeah, that's good. That would cover me.
Yeah. And just, on the, kind of going back to the, the first part of, what you were saying about the protocol timelines, right? Yeah, the activation queue, exit queue, and also the reward payout too, right? Once our validators or our clients validators through Lantern have reward payouts, like it could be 4 days, 5 days, whenever the cadence is, that's when we issue them right away. We don't kind of control, we don't withhold or control, because that's not what we're here to do. We're here to provide just direct access to staking as seamlessly as possible.
So the user experience that you are building on the front end, I guess is the word, when people land to your website, how many clicks is it going to take for them to be successfully up and running? Like they'll have a page where they got to do like the KYC stuff, and then they'll have to select maybe a couple of different options, and that's about it, right? Are they going to be able to monitor this on a phone app as well?
Yeah, so basically, just kind of like doing like the walkthrough in terms of like the user journey here, right? So they create an account, KYC, And then, let's say there's nothing on the platform yet, right? So basically they click deposit, right? And we're not doing a wallet connect or anything, so you have to kind of copy and paste. We have like a little clipboard, click, copy the sub wallet address for that specific client. Go to Coinbase, MetaMask, Kraken, wherever your funds are, your ETH is, and you could kind of deposit your ETH in that way. Down the line, we will be introducing direct buying and selling of ETH on our platform, but at launch, it will just be kind of you have to transfer it in. Once your ETH kind of lands in your account, you click stake, input however many ETH you want to stake, and you're done. We'll give you like an email notification on when you enter the activation queue, how long it's expected to take based on beacon chain data, and once you're finally earning.
That seems really simple and straightforward, and I think that a lot of that is because you're, like I said, you're not trying to be all things to all people. You're just trying to do one thing really good right out of the gate, and then the next logical step would be the buy and sell. Can you speak to any other partners? I know you mentioned BitGo. Is there any? What are your other partners that you're working with to tie all this together?
Yeah, so BitGo is our custody solution. We are using Persona for KYC. We use Chainalysis for kind of know your transaction and anti-money laundering. Oh. So for Persona, for people who haven't heard of it, like this is what companies like Square, Brex, AngelList, they all use it, and
BitGo uses them, yeah.
Yeah. And Chainalysis, I think a lot of people in our industry have heard about, but that's what really governments are using too when they're trying to crack down on like hacked funds or stolen funds or anything of the sort.
And I'm gonna see if anybody in the audience wants to ask any questions. That I'm just kind of moderating a few things here, but I'm sure there's plenty of people that maybe have questions. I do know that a lot of these folks from that do join the chat are usually at work listening in because of the time frame. But if there's anybody here that would like to jump in, let's rock and roll.
Testing, can you hear me?
Yeah, go ahead.
Yeah.
So I'm Jasper from Rocket Pool.
All right, Jasper's here.
Yeah, normally I don't get time to join in these, but I managed to find time today. So I'm curious what your MEV policy is, and if you could talk a little bit more about the chain of custody and key generation.
Yeah. So just to clarify, like Jasper, we're launching with third-party staking infrastructure providers at launch. So we're not going to be doing the staking in-house. Our MEV policy is to be compliant within the laws. So we'll be running flash bots, and and we'll have to follow OFAC sanction guidelines. And I'm sorry, what was the second part of your question?
I guess the second part wouldn't really apply, key generation and just management or validator key credentials. But since you guys are just using outsourced infra, I guess that doesn't really apply.
Right. That's right. Yeah. Custody-wise, yeah, everything will be handled with BitGo.
So BitGo is also going to be doing the staking, running the nodes?
It's going to be a mix of staking providers that are integrated with BitGo, at least to start. We're looking at a mix of infrastructure providers like Figment, Blockdaemon, Kiln, Foundry, P2P.org, whoever else we could kind of utilize.
Right.
But our roadmap is that in early next year or sometime like in the immediate roadmap is to like kind of bring that staking service in-house and start doing it ourselves.
What would stop one of your node operators or your internal service from using Rocket Pool under the hood? Like you have the ETH, you could just multiply the amount of ETH bonded by like 10x and then put up your own RPL collateral and collect the difference in the rake, right? The staking yield might be 3.5%. The node operator with the commission might be 5%. You have an extra 1.5% spread in this hypothetical. Could you technically collect that 1.5% for yourself?
Yeah, I think so. I think that is a potential solution. I think what gives us hesitation there is just that, I'm not sure if like we would then be getting an LST, like the RE token in return?
You wouldn't.
You would not. So as
Okay.
the node operator, you're the counterparty to the RETH holder. So the RETH holders are losing the commission that you're gaining. That's where that extra hypothetical rate difference comes from.
So I think I think that's a great option for us when we look to in-house our staking, like, because we're going to be running our own nodes at that point. So but that's again like farther down our roadmap.
I want to dive into that $200 million insurance policy a little bit. What exactly does that cover? Does that cover one of your node providers having a major slashing event? Does that cover loss of funds from a cold wallet? Does that cover, what does that cover?
Yeah, so slashing insurance would be separate, right? So basically we're utilizing BitGo. So again, at launch, right? We're using BitGo as our custody solution, and there's a staking API built internally that connects BitGo to the other kind of institutional staking infra providers, like, again, Figment, Blockdaemon, and so on. So the slashing insurance will be with the staking like infra providers, with BitGo, the custody. So the $200 million kind of insurance for custody, that is for kind of, so once we get into like a cadence, right, of, we do our alpha test and we launch and we see that, okay, on average, let's say 80% of funds are generally not moved. This typically ranges from, let's say, 10 to 20% of funds are unstaked, withdrawn, et cetera, and so on, right? In that case, like 80% of funds, or let's say 75% of funds, we move that down to our kind of a cold storage, which is insured by up to $200 million. And that, friends, kind of correct me if I'm missing anything, but that protects against like any like internal hacks or like what is like bad actors within BitGo as well, right? Any kind of loss related to that, and yeah, I have to kind of look into the actual kind of like bullet list on their website, but it's a pretty robust insurance policy.
Right. Most qualified custodians do have some kind of insurance that they provide. In addition to like bankruptcy remoteness, like if BitGo goes bankrupt, like the funds are still in like the client's names here.
I wonder if you could try to get some of these institutional stakers to switch over some of their Geth staking clients, because right now Geth has like an 80% majority, and if they get slashed running Geth, the $200 million insurance isn't going to do anything because it's going to go to zero essentially, the stake. So yeah, that's just an existential risk anyone really using third-party staking providers has to face. So the pressure points to get them to change would probably be at your level, really, where you guys are the middle people. So yeah, I was wondering if you can see if you can communicate with them on that.
Yeah, so some of them are more flexible and open to it than others. So it's just going to be a conversation, I think, with each one of them. I think some of them are already running, a minority client, but where they're not, like we're going to ask for definitely like to use a more minority client. And if they can't, then maybe, more of our volume goes to a different infrastructure provider.
So you mentioned
Go ahead, Jasper. Sorry.
You mentioned earlier that MEV, you're going to be following relevant laws and probably not running it. So my understanding right now is MEV is kind of, there aren't many laws. The only laws currently written are around OFAC censorship. So yeah, I'm wondering how you guys are going to be able to offer a competitive product if you're not capturing MEV just for the sake of maximal legal compliance.
So we are capturing MEV, right?
Oh, then I misheard you earlier.
Yeah, so I think with Flashbots, for instance, they have I think with Flashbots, for instance, kind of going to the
yeah, they have like they have like I think Flashbots like compliant and
there are relays.
And the other, right, and I think I guess if you're only missing out on the Tornado Cash transactions, it's really not making too much of a difference. I think you're still connected to enough relayers that shouldn't make too much of a difference.
Yeah, no, I agree.
Yeah.
So one of the things that Jasper is indirectly raising is the question of what type of influence can Lantern exert on its node operators. Like, could you get them off of Geth? But what else could you tell them to do? Could you say we're only going to direct it to people that have a certain amount of redundancy, or people that start or providers that are going to start using distributed validator technology? What type of influence can you exert on your node operators, and by what mechanism can you enforce that? Right? Not just asking politely, but other than withholding new nodes from them, what else can you do to them to exert influence, and what type of influence can you exert?
Yeah, I think it's nodes. What kind of clients they're running. I think there's definitely influence on the MEV side, and I think that's also, like doing things that. What else would you recommend?
It's not even just recommend. It's I'm curious because we have a big discussion going on the past couple of weeks about Lido, right? And saying like, Lido is because they have such a large percent, and because they're going to be able to do forced exits, they're going to be able to really use that as a noose around any node operator that's not compliant with the DAO's wishes. And when you do that with 33% of the Ethereum validator set, that puts the network itself at risk, where they could prevent finalization, for example. So some of it's healthy, some of it is not, right? It's a double-edged sword. So it's not even that I suggest, I'm just asking so that I know the difference between what Lido could potentially do and what Lantern could potentially do.
Logan, maybe you could, like, I mean, we could definitely, I don't know, advocate, like let us know if, like, you feel like I don't think we can tell them to, like, take Lido off as a client, or
I think I can try to rephrase it.
That's not what I was suggesting.
Maybe I can try rephrasing it. It's like,
yeah, that would be helpful.
Direct control, or what influence can Lantern, specifically Lantern, exert on your third-party contracted node operators? So let's just take the example. Let's say Lantern somehow gets corrupted and wants all of their node operators to start running this really special relay that actually is gorging fees to a separate party or whatever, right? Could Lantern do that? Like, do you guys have influence to the degree to get your node operators to switch clients to something out of band? Or, like, how much is it soft power where you guys just talk to them? And how much is hard power where you have, like, contractual obligation, where they have contractual obligation where they have to listen to you?
Yeah, there is a contract in place, but I don't think that, like, I would say that would probably be pretty out of scope, like, if they could, they would, look out for their own best interests at that point too, is my best guess. But it's a good question, and one that, could merit further exploration.
And just to be clear, so we're launching with those partners, right? But down the line, as kind of Prince mentioned, it's actually pretty high up in our roadmap, because we also want to pass on, like, cost savings to our clients, right? We will be in-housing our kind of validator, like the node infrastructure. So at that point, it's not so much as like a reliance on third parties and influence them, or and whatnot. It's we'd run our own.
Sweet. So how do you anticipate that transition going? Like, are you gonna?
So it wouldn't be. Yeah, I can't imagine it being like immediate sort of moving everyone over. It'd be kind of like a staggered, because in a way, it's kind of like a diversification of as well, right? Like, we kind of start with building our own. We're gonna test it, obviously, right? Maybe with 10% of funds, 20, and then kind of increase it, right? And kind of shift things over as we're building it. So it would be a gradual transition, if that's what you're asking.
Yeah. Do you guys also have any existing node operator experience to build off of?
No, but we have some partners that are really good with this, and we're going to probably build out a bit of the team to really specialize in kind of handling like the IT side and the server side for this.
Got it. It's trickier than it looks. I'll just tell you that.
Yeah.
Yeah, we've heard, and we're familiar.
At least for the professional side, yeah.
Yeah.
And you guys are funding. Do you want to? You're funded, or you're on your way to being funded. Do you want to speak to that at all?
Yeah. So we've recently closed our pre-seed. So we have, with that, with those funds, we're kind of spending on primarily on legal as well as kind of our dev team. Our CTO, he was one of the earlier like UX engineers at BlockFi. He was there for 2 years, left before all that, like implosion happened. Spent a year or so at Parallel Finance, and he kind of joined us after a few stints in entrepreneurship himself. So we have him. We have a few kind of developers under him, and so that's kind of how we're kind of funding ourselves right now with our pre-seed. After we do our kind of our alpha launch later in like a month or two, so like late October, early November, let's say. At that point, we want to kind of get user feedback and iterate on the user experience. And like let's say some of our clients want to see more kind of information, like than we initially provide, right? Oh, like I want to see exactly where I am in the activation queue, almost like a pie chart, like a bar chart, right? Where am I?
Like a Domino's pizza tracker.
Exactly.
Yeah, that's right.
That's the right. So kind of exactly where we are, right? Or like what, or do they like that format versus maybe they prefer another? So very kind of stylistic and kind of a UX feedback iteration, right? With that, we plan on raising a seed round, with which we kind of expand our team, and that's when we be looking at in-housing our staking and whatnot.
How many team members would you like to have by the end of next year?
By the end of next year. So right now we're at roughly like six folks.
Yeah.
We have one kind of contracted, like this, like not like a external kind of contracted designer, for instance. But by the end of next year, we'd want to keep ourselves pretty lean. Most of the additions will be on the engineering side, the development side. We'd say like 12, 15 folks. I don't know if you'd agree with that, Prince, but that's kind of how I feel.
Yeah, I think that's right.
With the most going to the dev team, we'd have maybe 2 or 3 dedicated to customer support, because we do believe that so Lantern, we're building Lantern for everyone, obviously, right? But primarily for what Prince and I like to call the crypto casual crowd. And the crypto casual crowd, the way we define it, are people who have crypto. They know they could do more with it, but they have like professions outside of crypto, or they're just they just hold crypto as an investment. They're interested in it, sure, but it's not something that they dedicate their most of their days to.
I mean,
right?
Sometimes,
sometimes
we talk to these people, and they hold ETH, but they didn't even know that they could stake it, or they've never heard of staking before. Yeah.
Right. So for that crowd, and I guess I count myself as part of that crowd as well, right? Like, phone support is a rare commodity. It's a rare commodity, I guess, in crypto, in my view, in my experience at least, and I think that's very important. So that's kind of where we'd be dedicating few headcount as well.
They can dial 1-800-LANTERN and get connected with an agent today, right?
Something like that, yes. Right.
Well, this has been great. I was going to see if there's any last questions before we move on, but personally, I'd like to thank you guys for being here. And what we could do is we should just do a follow-up, 6 months from now or so, what's going on in your world, and do a check-in. But anyway, I'm still talking. Anybody else want to chime in?
Have you given any thought to what you'll do when Eigenlayer comes out, whether you're going to support restaking?
Uh-oh. Prince.
I broke him.
There you go. Start over. There, you're here.
You're frozen for a second.
Robot
Team is
Prince.
excited about it.
Okay,
Can you guys hear me?
now go ahead.
Yeah.
Okay. Yeah, we're excited about Eigenlayer. I think, once it gets fleshed out a little bit more and it's the Lindy effect is taking place, it's a little bit safer, and it's definitely something we want to allow users to access with a click of a button. The ability to restake, I think, is going to be really powerful. And yeah, no, that's definitely something we want to enable. So we didn't really touch on this, but like there's, the way we're building Lantern is like with the staker in mind first. And so we want like a suite of products around the stake to better the staking experience, right? So like right now, if you want to sell the rewards that you're earning to fiat or USDC, like it's very manual. And, we want to be able to like toggle a switch where all of your rewards are sold, or like they're all like auto restake. Or like if you want to loan against your staked ETH, click a button and, you either USDC or like fiat to your bank account, like with a few clicks. And, the great part would be like your collateral is still generating rewards for you and could offset, maybe the loan payment and kind of become a self-paying loan. And so that's kind of like the mid to long-term vision that we have for Lantern. It's really like create great products and features around staking that just better the staking experience altogether, including Eigenlayer.
Any other questions? I was briefly looking at the Doots list ahead, and I really hope that you two gentlemen can hang with us, because I see Lido is in this week's topics, and I think if there's one thing here, it's been pretty cool having Jasper from Rocket Pool show up. That was sweet.
Yeah.
Thanks for hanging out. Yeah. And of course we got Lantern, but I think we all are on the same team with this Lido situation. So with that, I'm going to start going down the list. If you want to follow along with me, head to dailydoots.com. Right after the shitpost of the week here, we see Bart Hibbs shares some big news, which was almost missed by this. This forum must be very dead to totally ignore this nice news. So I'm going to open up the link here so we can look at it, see what's going on. This is from Our Cryptocurrency. Wow, actual useful information showed up on that sub. Let's see, which goes to a CoinDesk article. Click through to that. All right, New York judge declined to stretch federal securities laws to cover the conduct alleged in a proposed class action complaint seeking to hold Uniswap accountable for scam tokens. A New York court has dismissed a proposed class action lawsuit harm to investors by Uniswap. Interesting. The judge who oversees the SEC suit against Coinbase classified Ether as a commodity in her opinion on the ruling, even as the SEC has shied away from doing so. Let's see. I'm just kind of scrolling through here. The lawsuit filed April 2022 by a group of investors against Uniswap and its creator, Hayden Adams, alleged the DeFi platform violated U.S. securities laws by failing to register as an exchange or broker-dealer, offering and soliciting securities on an unregistered exchange. The suit sought to hold Uniswap accountable for investors losing money to scam tokens. Let's see. The case dismissed. The decentralized nature, there's your key word, of the Uniswap protocol made identifying scam token issuers, quote, unknown and unknowable, leaving no, quote, identifiable defendant in the case. Judge Polk Faya said in the opinion following Wednesday's order. That is pretty big, isn't it? I don't know if anybody wants to react to that, but that's pretty promising, huh? Can't go after Uniswap. They're just the highway system. They don't know who's driving on it. Awesome. All right. I'll move on down. If nobody's going to chime in, you just open up that mic and talk right over me if you want to say something. All right. User Minimal Gravitas posts their idea for reducing Lido risk on Ether research, and user Nomad Nuance replied with their thoughts. I finally turned my idea for reducing the risk of Lido's dominance into a post on ETH Research. There's a link here if you want to follow it. I've never posted anything in the proper Ethereum forums before, and so feeling very intimidated. Yeah, I mean, once you branch out of the shitpost haven of ETH Finance and start going to where like the people are that are running this ship, yeah, I can imagine. Minimal Gravitas been around for a long time. The very smart individual. I've never posted anything. Okay, so thanks to those who gave me confidence that it's possibly not a completely moronic concept. Nomad Nuance replies, my biggest issue with this is they could get rich quicker to flip control of Ethereum quicker and or after something goes wrong for them. You need to add something that stops the possibility, in my opinion, something like locking in some or all of these mega validators stake for that extra reward. I'm going to interrupt myself for a second. Is this regarding Lido on the Mavericks sidebar that I see? Anybody?
No. So this post is essentially about let's give mega node operators, mega services, higher returns if they reduce their essentially their attestation rate. So they get less control over the network, but they get higher returns. And you limit it to the mega node operators by having a high minimum Ethereum bond for this. The gist of it is like if you think that in the end state Lido has a supermajority and that it's inevitable, in this way the solo stakers can have an equal or greater voting share despite having less capital staked. The problem with this, which I think I agree with Nomad here, unfortunately, is that this only works at like a weird equilibrium where Lido has like, I don't know, like 60 to 80% of stake, and then that remaining 20% is very heavily on independent distributed node operators. Unfortunately, I think that's unlikely, and those node operators are just going to end up slowly capitulating to the Lido side for the higher rewards, and we end up in like a 99-1 state where even though Lido has reduced per validator influence, they just have such large scaling at that point that the effect is undone, and we're in a worse position than we started.
It seems like it would also encourage a whole lot of shell companies to pop up, you know, that are just like spin outs of these, you know, large, like, okay, now they got more money. They can open up another shop over here and start capturing there.
Yeah.
And it rolls into another company, you know, over and over.
Yeah, it's just proof of humanity, except for down at a company scale.
Yeah, that people who want to maximize their voting power are absolutely going to be doing that, which is also detrimental for the network because we're increasing the peer-to-peer networking load that way. One of the recent ideas that's been floating around ETH Research is increasing max effective balance, and that's largely to reduce the overhead load on the network. And this idea would have similar effects, but if we introduce the Sybil mechanism that incentivizes people to spin up new nodes at like very low sizes, we end up undoing that effect.
Interesting. How screwed are we?
Against Lido, we're not.
Okay,
look,
good.
So it is in Lido's best interest to have everyone think we're screwed. The more that we think we're screwed, the more likely we are to just give up, where it is absolutely not clear that staking is a winner-takes-all market. It seems very likely to me that it's just like the stablecoin market, and we're just far away from the end game, where the stablecoin market is like much more mature and has had literally like decades to evolve because stablecoins have been around so long. Staking tokens have not. Like, this is a brand new market, and all the new entrants are just going to take time to get to that point where they all have sufficient liquidity to be competitive. So yeah, I think Lido is trying to maximize their early staker advantage or their first mover advantage by making it sound like it's a lead that cannot be overcome. So it's like in their favor to encourage the idea that it's already over.
Okay. All right.
I would say I think we're pretty early in it. And something I was thinking a lot about was like the activation queue and how it's still around like 16 or 17 days right now. But, I think once that gets down to like sub 5 days, we'll actually see a lot more churn and, hopefully people diversify away from Lido, because right now, if they unstake from wherever they are and restake, if they have to go through the activation queue, that's like, 2 or 3 weeks worth of rewards that they're missing out on. And if it's only a few days, then, it's a lot more palatable to say, hey, like I can switch to solo staking and not give up so many weeks worth of rewards.
Yeah, that is 100% true. When we saw the deposit queue get up to like 60, or no, it was like 30 days,
like
I think.
40
45.
days.
Yeah, at the peak.
Yeah.
Not only does that inhibit people from switching providers, but it really is good for Lido because they have a very muted effect from the queue. So like the more ETH that's stuck in the queue, it barely moves their APR down. Whereas all the other providers, once they get ETH stuck in the queue, it'll quickly start hurting their APR. Just because of the nature of Lido's size, the proportionate amount of new ETH coming in that's stuck in queue inactive is going to be small. Whereas for Rocket Pool, when Shanghai happened, or sorry, when the merge happened and withdrawals were unlocked, we had a huge influx in our TVL. It was like a 50% increase in a matter of like a month or two. The downside was our APR got cut in like half, right? So it's like this natural self-balancing mechanism that is good in theory, but is actually really just entrenching Lido. So I've spent like a lot of casual time thinking about, is there a way we can modify the queue so that it's flipped, so that instead of entrenching the dominant player, it emphasizes the smaller players? But I haven't thought of a way to make it sound.
All right.
It's a good thought.
All right, we'll move on down the list because there's going to be more coming up, because I see Nixo is on this call and she's on the Weekly Doots. But before we get
I actually have to head out, but it was a pleasure joining while I could. I hope it's a good chat for the rest of it.
Hey, thanks for joining. Hope to see you next Friday.
I hope so too. See you.
See ya.
Yeah,
that was excellent. Very good. So set one less. MakerDAO wants to launch their own chain, and it's a fork of Solana. I thought it was a parody at first. And there's a post from Rune, Solana code base for new chain. MakerDAO new chain will mainly contain the back end of the Maker protocol and the sub DAOs. All user-facing products and systems will be untouched and will remain on Ethereum, L2s, or other large blockchains, and will be connected to new chain through advanced bridges. There's that dirty word, bridge again. Kept secure by the Maker protocol. Damn. And then Hanniabu piles on with even more criticism. Hanniabu says, Maker is a husk of its former self. Rune can't help but introduce more and more centralization. The end game is value capture. Quote, the most important reason for why new chain is needed is that it will allow the ecosystem to use hard forks to gracefully recover from the most severe form of governance attacks or technical failures. And then Hanniabu, yes, let's move to a less secure chain to protect against governance attacks, clown emoji. And then another quote from Rune from Maker, the second reason is that the Solana ecosystem has proven its resilience. And then Hanny replies, that keeps getting better. All that downtime really proves resilience. Another quote from Rune, the third reason is that there already exists examples of the Solana code base being forked and adapted to act as app chains. And then Hanniabu finally replies, there already exists examples of roll-up code bases being forked and adapted to act as app chains. Wow. Yeah, I don't even know how many team members, the original team members of Maker are still there. Interesting. I don't know if anybody wants to chime in on that. Otherwise, I'll get on down the list.
Well, I see you're wearing a DAI shirt.
Yeah.
So you must still support them at least a little, JT.
I have DAI. not a whole lot of dye, but I also like good puns and shit post t-shirts too. I have another t-shirt. I made it on it was Jack Games or whatever with the online games, and we were playing it, and you had to anyway, long story short, it's a really crappy Ethereum logo at the top, and then it says XRP underneath in really crappy Comic Sans. I don't even know what the joke is, but it's absurd. So yeah.
Well, I barely touch dye these days, honestly. Like once upon a time, you couldn't avoid it because 3 curve was everywhere.
Mm-hmm.
But now, I mean, you can get 2 curve, and it's just USDC and USDT, and you pair that against every other stablecoin in the space. So you have your GRI, and you have your TUSD, and you have your EUSD, and your every little USD XXX, whatever you want to call it, right? All those are paired against 2 curve, and you see just this proliferation of there's been sort of Cambrian explosion, because now you have forks of liquidity. They're using LSTs as their base collateral, and new money markets with things like Euler, right, that are using these LST collaterals. And so the sort of proliferation of LSTs throughout the space has created a pop-up of at least 100 micro DAOs are doing one little thing, just doing what the previous people did, but now using LSTs as the base collateral. I don't know, what is Liquidity and Bunny, right? Those are just examples of previously Convex or something that popped up because of LST collateral. There's just so many of these things that are popping up right now. It's all very quiet, right? Because they're not doing the loud liquidity farming. You can make your 1 billion% API for a week thing. So
what is the shit coin terminology that you would use for smart contracts? It's kind of like it, just because you can invent it doesn't mean it's worth doing. There's so many, everything's just so out there. People are playing in the sandbox trying to figure it out. Some of them.
Well, yeah, we definitely get seasonal designs. Like in 2017, you had your utility coins, because that'll make it not a security, right? And so everyone was like, okay, well, I can raise funds from around the world, and there's clearly some hunger at the time to do so. So they'll throw $100 million at you for a white paper, and why wouldn't you?
Oh yeah.
Regardless of whether people want to gamble directly with your fund token versus USD, right? It didn't matter. It was a fundraising tool.
Mm-hmm.
Then we got into this season of governance tokens. Governance over what? Don't even ask. Governance tokens. Okay. Does it have any actual rights? No. Why? Because the multisig ultimately has the rights.
Good point.
Right. And we're getting to a point where, yes, we have these kind of things that look a lot like securities, because they're ultimately a claim upon the revenue of the underlying DAOs. That's really what they are. Some eventual, however indirect the Rube Goldberg machine is, maker is a claim upon the underlying excess revenue of the system, right? They have a buyback system for that. Other people will use dividends. Some other people use rage quit, you burn your tokens in order to redeem an underlying treasury. You'll have others that they'll have a buyback, but it isn't burned. Instead, it's buybacked and then shoved into the liquidity pool. So just buy back and shove it into the AMM and build your own depth. You see Frax do a lot of that type of thing, right? But it comes down to, there's a token, and the people that threw money in initially did so with a profit motivation. The people that buy later are chasing the eventual growth of that system, and so it looks exactly like a security. But whatever, let's just not call it that. Don't do it if you're in the US, I guess, and you'll probably be okay. And I'm wondering what the next season, once we get, another season was, remember what they did with Olympus DAO? 1000% Clima, right? 1000% APR. People that didn't understand that inflation was a cost. That was an interesting little seasonal phenomenon. But I'm wondering what the next shitcoin casino we're gonna invent in crypto is. It's been interesting every time.
Pulse chain, man.
I don't think it's gonna be new L1.
Friend.
Yeah, so Friendtech is it's a way of tokenizing something new, right? But I don't think it's something that you can split out to 1,000 little copycats, right? I love the little experiment of it. definitely interesting, but it's not something I can just like copy paste and change a parameter and then get, another thing. Like what they did with yams one week, right? They took the model for Wi-Fi, and then we had yams. Then you had, I don't know, Pylon and KFC token. Like literally, there was a chicken.finance and everything, right? Because it was so easy to clone and change a parameter and then launch your own thing, and then people would ape in because they saw high APR. There was definitely a lot of that for utility tokens. There was definitely a lot of that for like your own forks. For a while, there was this crazy idea that we were going to use bonds, not liquidity farming, and somehow that was going to make the issuance via the bond wasn't going to be as destructive or something, right? Even though it was just selling it at a discount basically with no time lock. So there's been, it seems like DeFi is learning traditional finance one brick at a time, right? And so I wonder what the next brick is going to be. Are we suddenly going to get into gamma strategies? Like what's coming next?
Those bricks are breaking windows a lot of times, so that's
yeah. Well, you give a monkey a handgun, and you don't know what's going to happen,
right? You don't know where it's going. All right.
So in this case, we give monkeys bricks, and sometimes, yes, they end up in windows, and sometimes they make a foundation of something great.
Yeah,
we got a lot of bricks.
There's an infinite number of universes where those bricks can land in various ways. So hopefully, we're in the right universe eventually. I'm going to go down the list. User Scientist explains why he is surprised. This is going back to Maker again, that there hasn't been more eyebrow raising in response to Maker's recent move, which effectively made them an unregistered money market fund. Maker has deposited north of $1.2 billion of the dollars backing DAI into U.S. Treasuries. Whoa. The yield on those U.S. Treasuries is paid back to DAI holders who have deposited to the DSR contract. This is a near textbook definition of a money market fund, except an unregistered version. Golly. But KYC is inherently evil. This is a quote, "We should fight it when we can," unquote. Ethereum already allows for two people to send and receive ETH to each other, to transact without intermediaries and without KYC. But if you are literally investing in a financial instrument offered by the U.S. government, it's hard to understand why we can or should bypass clear-cut laws which exist for the rest of the members of society. And the absence of KYC is only a small part of the problem to me. The bigger part is the pure, unregulated nature of this enterprise. Rune is one acid trip in the Himalayas away from suddenly deciding the solution to world inequality is to arbitrarily donate half of the USG bonds to some charity. I'm not joking. The Maker core team is, at best, chaotic neutral with emphasis on chaotic. It's insane for a $4.5 billion stablecoin to rely on a group of centralized chaotic actors. And this is where registration of money market funds comes into play. You have designated legal responsibilities to core organizational members whose details are known to the feds and have clear auditing rules and what can and can't be done with the customer funds. And customers have clear legal recourse if or when the custodians behave outside of these narrow rules. Right now, DAI holders get zero of those clear-cut protections. I mean, maybe donating this shirt to Goodwill. And lastly, none of this fits within the original ethos or objective of Maker as an Ethereum-centric decentralized stablecoin. Nothing in today's Maker is decentralized nor fitting the core ethos of Ethereum, despite the team and the project having leached off credibility from the Ethereum ecosystem to bootstrap themselves to the current position as a major DeFi protocol. For example, if Jump or Binance came up with a protocol with similar shenanigans to that exhibited by Rune and Maker today, it would at best be a short-term pump and dump exercise, not a protocol which attracts and retains billions in total value locked over a long term. The only reason Maker manages to do that is because it managed to successfully leach credibility from the Ethereum ecosystem before pivoting into the present circus. End of rant. Holy crap, scientists. That was a banger. Good job, A-Word, for finding that post. That is pretty alarming, huh? Oh, wow. Okay. Moving on down the list, CoinAnon updates us on account abstraction standards. I'm trying to understand the current state and the near future of account abstraction. From what I understand, there are two competing standards: the SAFE, formerly Gnosis SAFE, architecture, and the newer ERC 6900 architecture. Having one standard seems important because it will enable dApps and developers to create plugins and modules for AA wallets. What is it? Account abstraction wallets? Okay. Automatic DCA, free certain assets, spending limits per session, etc. It's very cool, and I believe that it has a future, especially on L2s, with cheaper fees soon. But which architecture will win? The SAFE team is well respected, but it sounds like ERC 6900 has some advantages. Does anyone know the latest? Is the developer mindshare leaning one way right now? This was a good primer on different architectures, and there's a link within that post. Thank you, CoinAnon, for that submission. I see Nixo's in the chat. This one is her post. She rebuts a pro-Lido argument. I want to go to the original argument so we get the context here. This was from 4 days ago. Show the parent comments. Okay, so it was a tweet thread. Ryan Berkman's concerns around Lido's growth affecting Ethereum's reputation are misplaced. While Ryan admits that the, quote, realistic worst-case scenario for Lido's uncapped dominance isn't network disruption, unquote, the crux of his argument, I have to open up another window here, the crux of his argument for self-limiting revolves around the supposed reputational damage that Ethereum would suffer should Lido's market share continue increasing. In particular, he's worried about how this might affect Ethereum's growth, which in turn could limit its adoption. The counter argument here, of course, that threatening to throttle and or fork out Lido if it doesn't adhere to the will of a handful of core devs, researchers, or influencers is the surest way to kill any notion of better and safer property rights, which, as Ryan correctly points out, is one of Ethereum's strongest competitive advantages. And then, okay, so yeah, there's the safer property rights. Okay, and Nixo's reply, nonsense. PSYOPs to convince people that the, quote, will of the people, unquote, is to hand over governance to Lido DAO, when not even a supermajority of LDO token holders really want this. And there is a link to a tweet which illustrates this. The delegates who vote with the most LDO just overshadow everybody else. Sasha is trying to paint a, quote, handful of core devs, researchers, and influencers, unquote, as an elite group trying to maintain power. In reality, these are the hundreds of people who are building the Ethereum protocol layer and are trying to make it impossible for anyone to capture the Ethereum consensus layer. Like I said, PSYOPs. Quote, my personal perspective here is that it would be extremely irresponsible for Lido to gain a dominant market share without first significantly improving its resilience to long-term tail risks and reducing the impact of those tail risks on the Ethereum protocol. And then a quote from Nixo. Yeah, for sure, Lido in its current form shouldn't control Ethereum, but I think it eventually should and will. It just needs some tweaking before it's ready. As a tongue in cheek. And then back to the article or the tweet. I think it bears repeating here that Lido is not a single entity. It is a coordination layer between a multitude of stakers and node operators. And Nixo replies, it is 31 operators who can be removed at any point by one entity, the Lido DAO, which is swung by a few majority delegates. Many operators receive a significant portion of their income from being Lido operators. The threat of losing this income is a source of influence you can't ignore. Sasha's whole deal is coming up with long-winded posts that masquerade as research to justify Lido DAO governance expansion. Start with a conclusion and build arguments to meet up with it. He writes it in a way that often impresses people into thinking it might be a good argument, but he never actually gives us new information. He's not looking for an answer or doing research. He's just finding new ways to say, quote, It's okay for Lido to eventually become the middleman between you and Ethereum. Excellent, Nick. So I don't know if you are able to speak or want to chime in on this, but this was a banger, as usual, from you. Thank you. All right. 696 ETH made a big step in their solo staking journey, and 696 is in the house. I am proud to say I'm officially a Beacon Chain depositor. Yay, great job. I started my journey in late November and December last year. After researching and getting all the parts and setting up the Nook, I took quite a long pause. It was still on my mind, though. I wasn't following through with that. Oh, thank you, Osh Army. Hope you're okay. That sounds like you're in a bad blizzard. Let's see. Let me go back. It was still on my mind. As I finished addressing more critical priorities in my life earlier this year, I knew it was the time to do it. It looked honestly impossible, but I trusted that with the help of this community, EVMavericks, and my friends, that I would be able to achieve the feat. Staking aligns with my long-term financial goals, as well as with the future of Ethereum that I want to see, and I wanted to do my part, running minority clients too, to promote the health of Ethereum. My gosh, Superfizz needs to send you a Christmas card. Big thanks to Harog for basically hand-holding me. Thanks to everyone here in EVMavericks Discord for answering my many newbie questions. Shout out to ETHStaker for helping me out too. Also to a few of my friends from the dopest private chats, and to so many other people who were willing to lend a hand, but I already had enough support. I took my time to understand, learn, experiment, and to feel relatively comfortable. I'm sure it's not fully done yet, as I might be sweating when I pass the entry queue, but so far everything has been looking good. There's still a few things to set up bandwidth-wise for me and in terms of how to monitor, and I'm not sure what else to add, but if I remember something, I'll add later. If you have questions, let me know. Can't wait for my money printer to go burr and print me some blocks. So cheers to you, 696. Good job, bud. User Phi Marhal. Wow, he made the Weekly Doots the triple kill from last week. Maybe this is one of them. Google lets scammers, is Phi Marhal. Google lets scammers buy ad space and makes no effort to moderate this. Twitter is letting spam bots run free as long as they pay $8 for a blue check mark or $1,000 for a gold one. Wow, they're doing a $1,000 gold mark. Discord is adding a feature to let you hide links so they redirect to a different place. Oh my gosh. Let me say that sentence again. Discord is allowing you to hide links so they redirect you. This is going to be a big problem for me on Discord, because you get DMs and stuff like that, and what you're clicking on and what's actually shown on the screen are two different things. I have no idea in this current state of scams that they would allow such a feature, but here we are. There is a fundamental incentive problem with the law ruling big service providers that should have no accountability whatsoever for the content they host. Let criminals use your platform and get paid for it? Why shouldn't they take that deal? This is especially inane when said platforms do take moderation actions for various ideological or political motives. There's a fact. You're either a neutral service provider or you have administrative rights and exercise editorial content. You can't have both. In the latter case, you should be held responsible for your content, and sorry, but not sorry if this doesn't play well with big tech business model of harvesting value generated by user content while running only minimum human intervention. There is an obvious answer here. If these platforms were run as credibly neutral infrastructure as part of a distributed ledger, nobody can unilaterally censor. Those laws regarding lack of accountability would make sense. The mainstream internet as it exists today makes no sense as Web 2, whereas it would be sensible as Web 3. Very good. Yeah, I'll say it again. Discord has a feature now that lets you hide links. Scary. Just be vigilant. All right. Especially in these crypto forums, right? That guy, that gay. That's the username. That's that guy, the gay. brainstorms some solutions to the Lido problem. Here we go again. And Crypto Currency adds to it with a great reply. I see the solution to Lido problem as follows. Number one, reduce the advantage of pooling by burning MEV. All validators get equal beacon chain rewards. Solo validators have advantage over pool because of the LST fee. Number two, protocol level smoothing of block proposals or similar. Same way in proof of work. People use pools not because it gets the bigger rewards, but because they get them more consistently. And number three, make solo staking more accessible. How come there is still no double-click executable on Windows that gets you staking in no time? Even shitcoins have them. I wish I could make an easy answer for number three. I'm sure one of you guys could. But, yeah. All right. Crypto Currency responds to the first one about... to the second one about protocol smoothing of block proposals. Okay, he says, block proposals themselves really don't earn a lot of consensus income, only about 2 weeks worth of attestations. Once the impact of the MEV is removed from proposal income, I don't think block proposals will need smoothing. That's a good thing. And then finally responding to the solo staking with the double-click executable on Windows. He says, I agree on this. Back in the early days of Bitcoin, I used to keep my Bitcoin client running in the background to help provide bandwidth to the network and keep my wallet in sync. You would just double click the Windows executable and then forget it in the system tray. GPU mining was like that too. It should be just as easy to stake on Ethereum. The process should go like this. Number one, double click the installer and install. Number two, run the wizard. Prompts you to choose consensus execution clients with a short blurb about each one and a note about client diversity. Number three, you get kicked out into the main UI. Your clients are now syncing. There's a little progress bar that shows how long until they're synced enough to be staking ready. There's that Domino's pizza tracker. Number four, when sync is done, you click the little plus button at the corner of the main user interface to add new validators. And number five, for first time adding validators only, that wizard generates a staking seed, a seed phrase, prompts you to write it down, forces you to retype it. Number six, wizard prompts you to enter the amount of validators you wish to add, previews how much ETH you need. Number seven, the wizard prompts you for the withdrawal address you want to use for the validators. Number eight, wizard generates deposit data JSON file, prompts you to upload it and deposit ETH using staking launchpad. Number nine, wizard reads the blockchain directly, recognizes your staking launchpad deposits, kicks you back out to the main UI where you can see the pending status of your validators along with an estimate of when they will be through the queue. And finally, number 10, once they're through the entry queue, the app basically acts like a native version of the beacon chain, showing your attestations and effectiveness proposals, income graph, and stuff like that. I'm sure some people's heads are probably exploding at this idea of a Windows executable that's going to have your seed phrase pop up and all that stuff. The only case I could make for something like that would be like a complete native system of staking in a box kind of situation that when you turn it on for the first time, it goes through the operating system setup for the first time, and then it goes right into the staking setup for the first time. I can't imagine having an executable environment on a PC that's known to be running, previously. Like, I'm not going to do that shit on a bedroom computer that hasn't had a fresh reinstall in 10 years or 5 years or whatever. I don't know if anybody's got anything they want to add to that. I'm sure I'm preaching to the choir, but
I think Nice Node is maybe working towards that. I haven't followed up with what they're doing for a while, but
that's right. I forgot about Nice Node.
Yeah, they're a great little project where you can install and run a node on your home computer. But I totally agree with you. I don't know if that would be safe for staking.
Yeah, just there's so much sleepy down to the component level. I mean, we import so many parts. They constantly find these little backdoor attack vector things. I don't know. It's just, I think there's a reason why hardcore crypto community doesn't really have that for Ethereum. I don't know. But, okay, I'm going to move on. We got one more left here. Crypto Currency, man, made a double appearance on the weekly. Climbing up that list, boy. Explains a cool little defense measure in the Ethereum protocol, which protects against 51% attacks. Interesting. Hey, it just occurred to me, a 51% attack is not actually profitable to Lido in terms of ETH, at least in the short term. I forgot about this little quirk, a smart design decision in the Ethereum protocol. It reads, the reason why no validators receive attestation rewards during an inactivity leak is once again due to the possibility of discouragement attacks. An attacker might deliberately drive the beacon chain into an inactivity leak, perhaps by a combination of censorship and denial of service attacks on other validators. This would cause the non-participants to suffer the leak while the attacker continues to attest normally. We need to increase the cost to the attacker in this scenario, which we do by not rewarding attestations at all during an inactivity leak. And Crypto Currency goes on. So, by 51% attacking Ethereum, LST pool providers would be hurting the LST's own holders and their reputation for making profit by foregoing staking rewards for the duration of the attack. People would obviously rush to try to pull their money out, or at least they should. An attacker could avoid this mechanism by attacking with 66% of the stake. 66% is the point at which an attacker can attack the chain without foregoing short-term staking rewards. I just wanted to share this because it's a factor I had forgotten about, and it throws a curveball at any 51 to 66% attacker. And that is from Crypto Currency. Well, we are wrapping up here. I want to thank Jung and Prince once again for hanging out with us. I want to get you on the calendar when we get off the call, and maybe let some time pass. And when you guys are ready for the next stage of things, let's get you back on a call again and do a check-in with you. Does that sound good to you?
Great.
Awesome.
Yeah, and
go ahead.
Yeah, and thanks for having us on here. Really appreciate it.
Yeah, 100%. Really enjoyed having you guys, and all the best to you, and good luck with getting everything rocking and rolling. And yeah, don't be a stranger. Hop into that daily. You know, you can post updates. We want to hear from the teams themselves. Don't just feel like everybody's on Twitter. I know it looks like our sub is pretty quiet because we get about 200 to 300 comments a day during crab season, but I can assure you there is a big iceberg underneath the tip. All right. So there's a lot of people that read through there, even if they don't post. So let us know what you're up to and your next steps, and, use that sub as a resource if you have questions. And, I forgot to ask you, did you get a lot of people? I pitched it in the daily. I was trying to line up some people for you to interview. Did you get a chance to get a few people?
Yeah, we did. Thank you for that. We had at least like 4 or 5 inbounds.
Yeah, we had
Thanks.
like 5 or so, and more coming. So I really appreciate it, JT.
Yeah, no
Very
problem.
Insightful thoughts from them. Yeah.
And are either of you going? Maybe I've already asked you. Anybody going to permissionless Austin? Are you guys going down there?
We'll both be there.
Oh.
So if you guys want to talk to us more, we'll be around, and look forward to that.
Yeah.
Wait, JT, you said your barbecue was on Thursday?
It's on Wednesday.
Oh, perfect. Okay, yeah, I'll see you there.
Yeah.
Oh, no, I'm sorry. I think I'm leaving on Wednesday evening, so
Well,
I'd have to miss that.
I think
Prince will be there.
There might be leftovers. I got. I think that A-Word is driving to Kansas City, and then he's going to ride to Austin with me. So it's 2 dudes, 2 smokers in a minivan, and yeah, it's going to be on like Donkey Kong. But I'll get in town. Around Tuesday. Yeah, Tuesday morning, and I'll be there through. Sorry, I'll get there Monday morning, and I'll be there through Thursday. Yeah, I'll drive back Thursday, wiping like pork fat out of my eyes because I'll be probably hungover too. But anyway, All right, so we'll wrap this up. Stick around after the live stream because we continue the party in the hotel lobby. Don't forget to grab the POAP at dailydoots.com. The money stays with the EVMavericks and goes towards public goods. Stick around in Discord if you want to hang out. It's a great place to let loose when the parents aren't watching on YouTube. Hi, Mom. On behalf of Ethfinance and the EVMavericks DAO, my name is JT. Cheers and big hugs from Kansas City.